What's up, everybody? Welcome to another live Modern Lending podcast. This is going to be a really cool conversation. William Tessar, man, this guy's a legend. 30 years in the business. He's the president of Civic Financial. He joined in 2017. Previously, he was the president of 3 other mortgage companies, $35 billion under his belt. Also a top originator. He knows the game. He speaks the language. I love people who knows what it's like to get kicked in the face on a weekend trying to get loans. You know, he was a Glassdoor Top CEO, HousingWire Vanguard. Today, we're going to talk about private lending, which most of you think is Uncle Rico's van giving out some hard money, and the world of institutional capital. Let's kick it off with Bill Tessar. All right, dude. I wish we could be hanging out in person, man. Like this thing is fine. It's a great medium, but it'd be fun just to hang out, man. Good to see you, dude.
Good to see you too. I'm still working on the slide here at corporate. When I met you the first time, you remember that?
Yeah, absolutely.
We sat Helbridge down there, and he went flying through that thing. It was great, and we haven't built it here yet, but we're working on that.
Well, so Bill, thanks for joining us. This is going to be a fun conversation. I think a lot of myths are going to be debunked. I think we're going to have a lot of good knowledge spread about our industry and lending in general. You've been in the trenches for a long time. You know the game back and forth. Give everybody an understanding of what Civic Financial is, what they do, and your role there.
Yep. So thank you. Before I do that, just kudos to you, Alec. Listen, there's a lot of different ways people could have approached the pandemic, right? And without the conferences and all the normal marketing means, you decided to push your message socially with video and your podcast. I've been a follower. Great job, and kudos to you and Loan Depot for that. Civic is Wedgwood-owned institutional private money lender. They've been around for 5 years. Today, we're going into the pandemic, we were a top 3 or 4 lender. I'm not 100% sure about those other 3 or 4 today. So call us a top 3 or 4 lender in the United States. 20 plus, I think 22 offices spread throughout and lend in most, I think 26 states, 300 employees. It was funny, Alec, when I was kind of like putting some of that stuff together. In a lot of these podcasts or Zoom calls that I do, those numbers are impressive. And then I started thinking about Loan Depot and how many employees you guys have and volume and spread and breadth. And it was a gut check and a little humbling. But yeah, that's who we are today, and proud of it.
Awesome, man. Well, I want to talk about private lending. It's a unique place in the market. It does a lot of good. It provides a lot of opportunity for people. It opens doors that were closed in traditional manners. So what happened with private lending? I mean, the pandemic hit. Like the major crisis of our lifetimes, another one rolled through. I mean, you and I were both there at the previous mortgage cycle crisis, and this is obviously a lot different, but it smells similar. And what happened to private lending?
Yeah, so I think the first thing, everyone immediately compared it to the mortgage meltdown, and this was not a credit crisis at all. And conventional had to deal with their own crisis, right, with servicing values and hedging margin calls and all the stuff centered around that, and it thumped an awful lot of mid-sized to big lenders in the space. And the ones that had the balance sheet and financial wherewithal got through it, and others, got sideswiped. On the private money side, literally, Alec, what happened is on a Monday, a loan was worth 104 in Wall Street, and on Wednesday, with no rhyme or reason, the same Smith borrower, same FICO, same liquidity, same LTV was worth an 88.
Oh.
There were no bidders on that. And so ultimately, people that were holding hundreds of millions of dollars of paper that had booked X amount of dollars of profit on their P&L were posed with tens of millions of dollars of margin call.
It's devastating.
It wiped out 50% of our business, like literally the industry's business overnight. And so what do? You meet those calls and you play another day. You try to negotiate out of some of that stuff that doesn't work too well, or you close up shop. And you've been following what's going on in social media and whatnot. You've seen an awful lot of people do that. And And so, yeah, it exposed, I call it like posers, right? Because a lender who lends money should have access to a lot of money. And
it's helpful.
Yeah. And if you don't have access to money, you don't lend money, then you're not really a lender. And I think that what happened there was a lot of people, they got exposed for that. So yeah, it was an incredible time, and time being over the last 3 months. And I think it ultimately forced that space, this private money space, into 3 buckets. The people that survive, they'll thrive, right? Large capital bases, good balance sheets. The ones in the middle that are trying to figure it out, they've been on pause. You see those, we're not lending now, big furloughs, but we're going to be back, trust us. And then people that are just no longer.
The trust us, man, that's a hard one. I feel that's a hard space to be, because you got to come back and earn that trust back. I've seen a lot of, like, in the non-QM space, and people come back like, we're back. And we're like, we don't trust you because we were holding the bag when you left. So I think there's a lot of that it's going to take some time.
You know, it's funny because the question as an originator, you and I would ask if we were out there on the street and we came across a non-QM opportunity, we would say, what are your products? What are your price? How high a LTV? How low a FICO? What do you need to see? Now it's like, tell me a little bit about your capital base. Like,
that's so true.
About your financial stability as a firm, because nothing's worse than a company calling you and saying, we are ceasing all funding operations effective immediately.
Oh yeah, I mean it is a loan professional's nightmare, not only for the corporation but for the loan officer who's got that deal midstream and goes, "Oh no, my integrity's on this deal." So yeah, it's ugly. You to
the borrower, you to the AE, or to the realtor, you to the financial planner, and all their ancillaries. Yeah, it's just, and they don't want to hear it. No, I trust you. Don't tell me about ABC non-QM or BPL company.
So what was Civic's response to the pandemic? Bill, how did you navigate through it? And by the way, I know we're still in it, but I think some of the darkness is behind us.
Yeah.
Share your thoughts. How did Civic do this?
You on that? I do think it's more in the rear view mirror and making sure that we're mindful of the wake of stuff that's behind us, as opposed to like front facing. So we implemented a continuity plan. That was like 90% of our employees work from home. Now, just from an IT perspective, when you think about first responders, when this is all done, we should celebrate IT for allowing all our AEs to be able to operate, because they're the heroes of the mortgage world. And I think you'd agree with me on that. So setting people up, and account executives and loan officers, we've gotten a little bit needy from the times that you and I first started doing this. And so they need double screens, right? And they would like to have a printer in case they need to kill a tree. And so we had to set everyone up that way. And our IT team did an incredible job on that. So that was number one. And we did it. I think we have 99.5% of our workforce. Anybody that isn't with Civic were performance issues related to originations, not operation issues. So, lending uninterrupted was a big thing. And you would say, well, you're a lender, you should do that. Well, I know, but there was a lot of things you had to navigate. And so the continuity plan, continuing lending with all of our products was super important. Establishing new takeout and financing arms in Wall Street. We talked earlier, Alec. One of my strengths is I got very, very strong relationships on Wall Street. And so I'd say 50% of my time was in and around that, making sure we're aligned with proper takeout and financing options so we could continue to offer the products and channels that we were offering in the marketplace without a hitch. And
I want you to unpack that, because this is an angle not many people get to have. What was happening in Wall Street during that time, which was so close, so like not very long ago? Like, what was happening?
Yeah, for all you football fans, it was a big Heisman to anyone that needed financing or needed someone to buy financing. That's really what it was, and they had to figure out. So if Bill Tessar Financial is dealing with a $10 million problem, and Alec Funding is dealing with a $100 million problem, Wall Street was dealing with billions of dollars of problems, right? And so they were dealing with aggregators that couldn't meet margin calls. They were dealing with warehouse lines that were getting swept. They were dealing with serious liquidity issues. And so they didn't want to hear about Bill Tessar's loan that was approved, and we're trying to figure out a way to fund it. That was like, there was a non-conversation. And I think what they needed to do was they needed to figure out which big aggregators were going to survive and how they were going to work around that economic exit, which ones weren't, and how punitive that was going to be if they were sweeping accounts and they had to sell that paper, and what that was going to look like. And then when they were going to reemerge. And so where I think they are today is, I think that all of that identification is done. They know who's making it. They know who has a good chance, and they know who got shot. And so that's been determined. And I think those paper pools have been traded, and they're trading in the mid 90s. We could talk about that in a second. Yeah. They're starting to reemerge. So we're seeing people that are saying, hey, let's talk about the 1-year bridge product again. And that's coming back. And so I'm very enthusiastic about what third quarter going into fourth quarter looks like from a Wall Street perspective. And they're getting to go back to work in July. You know, New York was just crushed from a number perspective. And we know a lot of big players that are migrating back into their, wave response.
It's a little bit of a tangent, but it's just wild, the adaptation happening right now. And it's so self-evident. The companies that can adapt and evolve are the ones thriving and winning right now. And the ones that really struggle with that are just frozen, non-existent, and it's wild to me what's going on. So I want to hear about what other types of lenders are in your space right now. Who's out there in private money? What's the world look like? What's the landscape?
Yeah, and so look, I want to be very careful. I'm gonna block it into 4 different segments. Okay, sure. I'll start with the larger aggregators like a Civic. Okay, right? Doing $100 million a month in volume and having multiple outlets in Wall Street that they could either sell at a pass-through, sell at a premium, or securitize.
By the way, I just need to make the comment. I know you were joking earlier about scale and size. The first time I realized that Civic was doing $100 million a month in private lending, it blew my mind, because I was so in my lane. I wasn't, I don't pay attention. I'm just, and all of a sudden I was like, oh my God, that is a lot of people that you're providing loans to.
Especially since Loan Depot does 100 million on a Tuesday. but on the private money side, Alec, you're right. We do a lot of volume, and listen, our whole thing is quality, quantity, consistency. We get a lot of looks. Yeah. A lot more than 100 million, and 100 million gets through the small little snake and out the back door. And yeah, so we're certainly proud of that. There's going to be 4 or 5 of those nationwide.
Bigger players.
Yeah, that emerge. And then from that, then the next is, I called them posers. Posers is probably a little aggressive on my part, but let's just say they're susceptible to market swings where products can come in and out based on balance sheets or liquidity.
Yes.
Right? So that's probably
a very politically correct way to say it.
Yeah, smaller to mid-size range lenders. I do think it's important just for everyone to know who you're working with, because you got so many people depending on your professional guidance. And so I think that's the second group. The third group you and I teased about are the country club lenders. And so many people have done what we do. And then when they retire, they've accumulated a little bit of wealth, and then they want to put that back into the market. And they're, 50, 60% LTV, 11 to 13%, 4 or 5 points. They know the area. They'll go drive by, quick look, drop docs. You're done in 3-4 days, and you pay for what you get. And you joked it's Joey Gallo down there in the Bronx, and if you don't pay, you're going to meet his brother Vito. So they're, and I'll tell you what, they have kind of reemerged, because as everyone's rates jacked back up because there was no value, they started actually seeing some more activity, and good for them. They've been around a long time. Basically started hard money, private money. And then the last one are the fund managers. And those are groups or guys that go and raise $100 or $200 million. They got it. They set up a guideline, and then they lend. And then when it gets full, they have to go raise some more money. And I think you see a little bit more of those groups in or around there. I think that's the 4.
Okay. And how do you see those 4 evolving? I mean, I think there's a runway forward, and you kind of said it too. Like you're looking forward at Q3, Q4, and I know a lot of us are. Like I kind of want it to be 2021 a little bit. Like just like my kids go back to school, please. But like you bucketed these 4 groups. How do you see them at from a market share perspective or a growth perspective, kind of moving forward? Where are they going?
I see it a lot like I see your space. Like you and I, we joked about a year ago about the winter of death.
Yeah.
And I still, in my heart of hearts, believe that's coming. I believe it's coming on the conventional side, where the mid-size players that are operating on a shoestring are going to either become smaller brokers, or they're going to align themselves with bigger companies like Loan Depot. So that's number one. Number two, and so on our side, I think it's exactly the same thing. I mean, in lending, you have to have the ability to lend. Capital is important. If you don't have capital backing, you're not a big lender. And so it's more important now than ever before. And I think it's also more important now from a Wall Street perspective, having a fresh eyes on how people responded in a economic trauma situation. Did they make their margin calls? Did they have enough liquidity? Did they boost up their balance sheet? Did they answer the call, or did they shut the door? So I think that's going to happen on our space. I think it's going to happen on your space.
Agreed.
I think the mid-size regional players that are kind of operating super tight, I think they're going to have to make a decision.
Yeah.
Either get smaller and just operate within their means and say who they are and act that way, or they're going to have to align themselves as a broker or go with a bigger firm. I think the country club lenders will be here long after our children are grown up and gone. They're never going away.
No.
And I think fund managers will not thrive but survive, because there's a marketplace for nuanceical type of lending that maybe Wall Street's not buying.
So I want your perspective on this topic. It's semi-related, but it's in the space, and I know a lot of the financing you guys provide goes to investors that are flipping property, that are that are real estate investors. It's short-term financing options. They're going to do whatever they're going to do with their property. They maybe make it a long takeout later. And so what's your unique perspective on the flip market? Because there's a huge, I was just talking to a group in New Jersey this morning of realtors, and there's no supply. They're in multiple offer situations. It's just wild. And that's like that across the country. There is not enough homes. So how do you see the flip market evolving? What's going on there with investors and housing?
I think the flip market opportunity is huge. So we started by saying that Wedgwood is a parent company of Civic. Wedgwood is the largest purchaser, fix-up, and flipping company in the nation. They have purchased, fix-up, and flipped just under 50,000 properties. Their run rate's about 4,000 a year. When you were here, you got to see upstairs and how they operate. Here's what I will tell you. I'll talk to you about the sell side first, and then I'll go to the buy side. On the sell side, we have about 1,800 homes in various different stages on the market.
Wow.
We're trading at 102 to 104% of list price, over list.
Got it.
Multiple offers, no concessions for first-time buyers and then the step-up buyers. Okay, so we don't see any massive real estate we don't see any depreciation whatsoever in that space. None. The bigger stuff. So out here in the South Bay, right? The average you can't find a scrape for $3 million. So out here, the bigger stuff, maybe I said it was 7 to 10%. It's probably 3 to 7%, and that's just because some of those people are looking at just it was a flip there, so they're getting out of it. So I think that market gets hit a little bit, but the market no one's talking about is the iBuy market. And so
actually, I've seen articles say, well, first of all, everyone wants to crap on the iBuy market, in real estate, because they feel like they're coming after their cheese. And so I watched a lot of real estate publications, and a lot of people kind of like, oh, look, they're out. They stopped buying. They left. They disappeared, and I was like, well, I think they're just kind of waiting to see what happens. They didn't go anywhere. I would love your take on the iBuyer, because I think it's going to be a significant portion of how deals are done in the future, similar to how people turn in their cars when they want the new one. And I'd love your perspective on this. Yeah, so the bigger iBuyers, like the biggest in the space, actually use Wall Street or use Wedgwood as an outlet. And so I'll talk about that, right? The basic model of iBuy is
it's a tech play. These aren't real estate pros. These are tech pros that have access to a lot of capital on Wall Street, lots of capital, and they've created a really neat engine that in their mind, they're going to find low capex properties where people have to exit quick, paint and carpet, back on the market, make small little margins plus whatever the 3% they saved on one side of the real estate transaction. The problem with that, Alec, is it hasn't worked that way. First of all, even one of the biggest, without naming a name, they take in 35,000 iBuy opportunities a month. And out of the 35,000, they'll transact on about 1,000 of them. And the other 29,000 were either out of the areas, the price was too big, the CapEx was too high. So what we've seen at Wedgwood is we've seen that go to us. They have a pipe that comes right to us so they can offer those people a price that they could transact in. Those big iBuyers have a backlog of real estate that they're underwater. And so they were buying and trading to like a 92, meaning like maybe 8 points. I think they're going to have to reemerge in the market somewhere in the mid 80s to, meaning if you found a property that was worth 100,000, you got to buy it for 85,000.
Exactly. Yep.
92. And so I think they're not gone. They're just going to have a different model. And there's a backlog of those properties that I believe from a flip standpoint, they're going to have to unload, and they're going to unload at a loss. And then the flippers in the world are going to have an opportunity to grab some of those properties at a loss and transact. And I'll tell you, we're not seeing a slowdown for fix and flip opportunities. And I was a little skeptical about what tomorrow would look like. Yeah. I'm not seeing it. Our flippers, their interest rates are a little higher, Alec. Sure. A little bit more money for money, but they're also getting a little bit better deal. They're turning their real estate a little bit quicker. And so they're making it up in some of the other line items on their ROI analysis.
Well, with the demand out there, they're probably picking it up on the sale more than they probably ever did because there's not a lot of homes to buy.
Well, and then off the heels of that, so look at Civic, when we make a decision to lend money, we're lending believing that person's going to pay that loan on time as agreed. And when the loan is due, they're going to pay us off and we're going to go on. And that doesn't always happen.
No.
Like just under 1% of the time, that loan will go down. It'll go in a default. It'll go through REO and we'll take it back. Right. Mm-hmm. That's the reality. And because of our association with Wedgwood, we're very, very good at foreclosure and REO, and we're not afraid of that. But here's the interesting thing. Our REO is flying off the shelf. Like I had an asset management meeting before this call, and we've never seen the multiple interest and calls pre-sale like we're seeing right now. Never, ever before. So I think the market opportunity is huge. And, for those that survive and thrive, wow, tip the cap to all of them, right?
Yeah, I think we're entering into an unprecedented time for lending. I think one of the tipping points in our world is going to be the Quicken IPO as a benchmark set for what the industry is worth and how the valuations are set and all that stuff. And I think as lenders, with this rate environment that we're going to see for a long time, I think it's going to be one of the most unprecedented opportunities that any of us could ever had in our lives.
It's funny because if you go look at your LO base right now, how many LOs do you have?
Oh my gosh. Across the country on our whole platform?
Over 1,000, right?
Oh yeah.
So if you look at them and then you just look at the length in the business, this will apply to a portion of it. But what I hear over and over again from loan officers or A's is, I'm so busy. I've never had more loans. I don't know where. I go, hey buddy, gal, enjoy it. This is not normal. I know it's been normal for 4, 5, 6 years, or 2 more years, whatever. It's not normal. So just enjoy it, get market share, love your customer for life, make sure you're nurturing your database, because rates will not always be at zero. They're going to go up. In the interim, where your market is right now, I think conventional lending is saving the real estate market. I think the rates are so low. Like you will pay more for a piece of real estate because the rates are so low that the economics make sense if it's a long-term play.
Yep. 100%. The buying power goes every time the rates go down, the buying power goes up.
It's unbelievable. I don't
and,
know.
And we also find ourselves in the United States today where there's more equity in homes than there's ever been in the history of our country. So we have equity, we have really solid, some can argue too tight, guideline restrictions. So we're lending really strong paper to people on, fully documented, all the stuff's buttoned up, QA'd 17 times over, and rates are in the twos. It's bananas.
How is that even, like, my God. Doing the math, if anyone just gets a mortgage calculator on, how much do I qualify for, you start playing the games with the interest rate, every single person that plays that game goes, oh my God, I could buy so much more home than I ever thought I could buy. And they become part of the new market. So,
and the other stuff on this bill that's incredibly cool is debt consolidation. I mean, everyone, like, we live in a culture of like maxed out credit cards. I hate to say it, but we live in like that kind of culture. And all of a sudden they go, wait a minute, I can take all this high interest. I'm saving like $2,000. I'm seeing people save like $2,000 a month. That's real cash. Like that's a life-changing amount of money per month for some families.
Yeah, and if it's under the 750 threshold for interest deduction on your home, then it's tax deductible as well. I mean, there's a big play there.
Well, so Bill, I want to pivot a little bit because you've been in lending a long time. You've managed big firms, big on the conventional side, on the private side. And I love this conversation, this question, because a lot of the people that watch this are mortgage professionals, sales professionals, and I love to give them perspective. And so I would love you to share yours. And so if you're sitting there, which you do now and you've done before, and you've got loan officers in front of you, let's say you got a brand new one who's never been in the business before, and you got a 30-year vet, and they're looking for you for advice right now. They're saying, hey, Bill, you've done a ton. You've been around. You know a lot. Man, what should we be doing with our careers right now, our businesses? What strategy should we be doing? What advice are you going to give these people?
So I would say two things. Number one, my entire career, I would boil down origination to two parts. You are building your database through new customers, and you are nurturing your database and making sure nobody else ever has an opportunity to work with them. So no matter what, every day of the week and twice on Sunday, if you only remember two things, those are the two most important things you could remember as an originator. And then I think today, it doesn't matter how long you've been in the business, you need to be chips all in. You need to be chips all in. You're going to have plenty of time to go and watch Netflix and CrossFit and all the other crazy stuff that we all do all day, every day. Chips all in. Trust me, 5% is coming back. 7% is possible in the future. We're not staying at these rates forever. So no matter what, chips all in. And, I joke with our guys, this is no practice life. We get like one shot. And like for me, I'm closer to the end than the beginning. So the idea of kind of wallowing through my day with mediocrity in my mind, it's just not, I'd rather just retire and, call it a day.
But, you said a great point, and I want everyone to hear it. Like when the fish are swimming, you gotta be fishing. And when right now the opportunity is all around you and your chance is unprecedented to grab it and hold on. And then I would give people two pieces of advice to complement what Bill said. Number one, save your money. Save your money, invest it wisely, because right now it's so tempting, especially if you're a younger originator and you're like, oh my God, I'm crushing it right now. I'm making more than I've ever made in my life. And you're buying dumb stuff. Like, just don't, save your money, because this does not happen all the time. And then the second thing is, man, work as hard as you want right now, because now's the time. I mean, chips all in, Bill, you nailed it. Now is the time to work as hard as you possibly want, because all of it is yours. And the last thing I'd say is, don't forsake the new skills. I think COVID has a silver lining, and the silver lining was it pushed a lot of people into new skills, because the things we used to do to originate and build influence, we couldn't do anymore. And now all of a sudden we realize, hey, I've got to get online. Hey, I've got to build digital community. Hey, I've got to figure out this camera thing and this lighting thing, and I got to figure out how to make impact. And right now you're getting loans and they're falling from the sky, but do not forsake learning new skills, because this too shall pass. We'll be back in a more normal world. Who knows when? And if you don't focus the time on the new stuff that's going to take you to where you want to go, you'll be left behind. So, Bill, that was really good advice, dude. Let me do this. What states are you in, Bill, with Civic? Remind everybody. Because I want to say this. You've been a tremendous partner for us at Loan Depot. Like a tremendous partner. Like the way you guys operate, the professionalism, the talent you guys have, and the solutions your products provide is really important, because we watched a lot of people, a lot of companies whose product lines got thinner during COVID because there was risk and forbearance. And now we have overlays and restrictions because we're like, oh my God, we're catching knives here. Is this person going to go into forbearance? I'm going to be stuck with the bag. And you guys have continued to drive a creative product that have helped tons of people that don't fit the box. And so what states are you in so people that are watching this in the past or in the future they can find out how to connect with you guys?
Yeah, so Western United States, and we've added a few, so I won't be exact, but like North Carolina, Pennsylvania, Jersey, coming, Tennessee, Atlanta, DC-ish area. And I think it's on our website too.
It is.
Yeah.
So Bill, leave everybody with this. What would you tell somebody who, for them, and they're watching this, it's their first exposure to private capital. They don't know what it is. It's their first exposure. What do you tell those people? What's your elevator pitch for what you do? Let's leave everybody with that.
Okay. So we said early institutional private money. What does that really mean? It's short-term bridge capital. We also do some longer-term rental for people that don't qualify for conventional financing. It's all non-owner occupied business purpose loans. So we're not subject to a whole bunch of the stuff that we've been subject to on the conventional side. It's generally speaking 8.5 to 10.5 rates, depending on the borrower. It's not FICO driven. There's no tax returns involved. Reserves are 3-4 months type of thing. It's really more, I got a borrower, doesn't fit the conventional box. I need to solve a short-term issue, and off you go. I think what I would do, Alec, and we've aligned a few of our AEs with your branches, is I would just recommend that they, through their managers, get in touch. And then through Zoom, we could do a 15, 30-minute presentation of products, price, and process.
Well, no, and that overview was helpful. There's so many opportunities that you guys provide. And for sales professionals in the local community, knowing the arrows you have in your quiver, knowing what you can offer people to be that subject matter expert, to be that resource is huge. And what Civic comes along is fills a lot of holes in the armor and provides a lot of good for a lot of people. And you're a wonderful partner, and they're really lucky to have you at the helm there, man, because you know the game.
Thank you for that. Appreciate it.
All right, friends, family, guys, we're wrapping down. Look, if this added value, or if you're watching this in the future, hashtag bypassed, comment, hashtag bypassed. If you're watching this in the future, I want to know, I want to connect with you guys. Like, subscribe, share. I appreciate you guys. We'll see you next week on the next episode of the Modern Lending Podcast. Bill, see you.
Thank you. Talk to you soon.